Hello, and thanks again for tuning in. Here's a question I get from time to time. If I don't have enough income to qualify for a home purchase loan, refinance, or a bank HELOC, then how can I qualify for a reverse mortgage? It sounds too good to be true. So today I'm going to show you why and how the reverse mortgage is easier to income qualify versus other conventional real estate loans and bank HELOCs. So here's a scenario. A 62-year-old widow, Barbara, has an income of $2,500 per month. She owns a home with an estimated value of $800,000. There is an existing mortgage balance of $110,000. She would like a home equity line of credit for an additional $200,000 to have for cash flow and in the event of emergencies. Please note that this is a reverse mortgage HECM line of credit example where the minimum age is 62 to qualify. There is another reverse mortgage line of credit option out there where the minimum age is 55 years. Income qualifying for these 55 and over loans are similar, but are different as well. They have different rules. So please check my YouTube channel for the 55 and over reverse mortgages for differences between that and the HECM. So back to our example. So Barbara has property taxes of $2,500 per year, homeowner's insurance of $1,200 a year, a $320 a month auto loan payment, $75 in credit card payments, and has an existing mortgage payment of $1,100 per month. And she's got excellent credit. Barbara goes down to her bank to apply for a home equity line of credit. You would think this is a good risk for the bank. A home with an estimated value of $800,000, mortgages totaling $310,000, which again is comprised of the existing first mortgage of $110,000 plus the additional proposed $200,000 HELOC amount. That'd be a good deal for the bank since there's equity in the property, plenty of equity. In this bank HELOC income qualifying situation, Barbara would need monthly income of $12,000 per month to qualify for this HELOC. She's $9,500 short in monthly income to qualify for the bank HELOC. Here's why. With the bank home equity line of credit, having an adjustable rate and the bank not knowing what future interest rates are going to do, the proposed HELOC monthly income qualifying payment is calculated by taking the requested line amount of $200,000 times 1.5% for a worst-case scenario payment. Now, this is not the monthly payment Barbara would have to make if she pulled out the entire $200,000 home equity line of credit proceeds at closing. It's strictly a payment used to qualify for the HELOC. So in this case, $200,000 times 1.5% is $3,500 qualifying HELOC payment that must be included in Barbara's total payments on the HELOC application. Add to this figure her existing mortgage payment of $1,100, property taxes and homeowner's insurance in the form of a monthly payment, which is $308 a month, along with her auto loans and credit card payments together being $395 a month, and that adds up to $5,300 a month in debts. HELOC lenders typically do not want any more than 45% of your gross income going out to total debt. In this case, $12,000 in monthly income would be needed to make the numbers work, since 44% of $12,000 is roughly $5,300. Banks may use varying debt-to-income ratio formulas, but the one I've used is one of the more common used by HELOC lenders. Needless to say, Barbara cannot access her equity with a conventional loan or a HELOC due to her lack of income. The equity stays locked up in her house, she isn't able to improve her quality of life, and obtain funds for emergencies. It's important to note that if Barbara was able to income qualify for this bank HELOC, if she had the $12,000 per month, her actual minimum monthly payment would usually be an interest-only payment spread out over 25 years, which would be much lower than the qualifying payment. However, a reverse mortgage loan has a different way of income qualifying that will help Barbara's situation. We will use the same debt numbers as a prior example for reverse mortgage income qualifying. The reverse mortgage does not use debt-to-income ratio formulas like the HELOC or conventional lenders, as I just showed you. Also, the reverse mortgage does not take into account any monthly mortgage payments when qualifying for the loan, since monthly mortgage payments are not required on reverse mortgage. In exchange, the interest that accumulates each month, if not paid, gets tacked on to the balance of the reverse mortgage loan. That's the trade-off. All accumulated interest on the reverse mortgage loan is collected when the loan gets paid off. And if you end up owing more than the home is worth, you aren't on the hook for the difference. The reverse mortgage loan is a non-recourse loan. However, a HELOC is not a non-recourse loan. If you do owe more than the property's worth, you're still on the hook for that difference. The reverse mortgage must also be in first position. In other words, it has to be a first mortgage. So that means that Barbara's existing first mortgage for $110,000 must be paid off with the reverse mortgage loan. Then the requested $200,000 line of credit that Barbara would like to get added to that would be wrapped up into one $310,000 reverse mortgage line of credit loan. So the existing first mortgage payment goes away as well. No monthly mortgage payments for the rest of Barbara's life, or as long as she keeps the reverse mortgage loan and the property stays her owner as her homeowner occupied residence. Can't rent out the property, in other words, but you can rent out rooms as long as you live there. The reverse mortgage uses something called residual income to income qualify for the loan. For a single person in a high-cost area like Southern California, where I am, Barbara, after paying her monthly payments for her car, credit card, and property taxes insurance, would need $583 left over in order to income qualify for a reverse mortgage. Again, that dollar amount is for high-cost areas like Southern California. Does she have that? Let's take a quick look. So we have $2,500 in income. We subtract for that property taxes, insurance in the form of a monthly payment, which is $308. Take away your credit card and auto loan payments totaling $395, and an estimated total of utility payments, which we didn't use on the HELOC, but we do use it here. We have a formula that we use to calculate utility payments. In this case, is $270. All that adds up to $973 in debt, and we subtract that from the $2,500 in income, and what we have left over is $1,527. Then we subtract the residual single-person income required in Southern California high-cost area of $583, and she's got $944 per month left over. So Barbara does income qualify for a reverse mortgage of $310,000. In fact, she would need a lot less income of $2,500 to qualify for $310,000. If that figure was a negative number, for example, and Barbara doesn't meet the preliminary income qualifying requirement, and she may not income qualify for a reverse mortgage. But if it was a negative number, hypothetical income can be used from the $200,000 available credit line, and using an algorithm which uses her life expectancy, additional income can be created over her life expectancy to add to the equation, which could make the numbers work. So there are unique ways to come up with additional monthly income, if needed, to income qualify for the reverse mortgage, assuming there's ample available credit on the line to use. So again, for Barbara, $2,500 income per month is enough to income qualify for the reverse mortgage of $310,000, and the fees for the loan, other than the appraisal and borrower counseling, can get rolled into the loan. If you want to know more about fees for the reverse mortgage, go to my website, to my YouTube channel. and I have a video on there on fees for the reverse mortgage. One thing important to note is that if more people live in the home, a greater amount of residual income is needed to income qualify. Also, the amount of residual income needed to qualify can vary by county. A reverse mortgage professional can let you know what these residual income figures need to be, depending where you live and how many people live in your home. There's some other important differences between a HELOC and a reverse mortgage line of credit you need to know. First, a HELOC gets frozen after 10 years. A HECM reverse mortgage line of credit stays open for the rest of your life. A HECM reverse mortgage line of credit doesn't get frozen if home values drop. A HELOC can get frozen permanently if home values drop. A HECM reverse mortgage available line of credit grows each month. Notice I say the available line of credit grows each month, which gives you more funds to use. A HELOC doesn't do this. Again, visit my YouTube channel, and I have additional videos explaining the HECM available line of credit growth. Also, I've got a video that tells you that not all reverse mortgages are HECMs. You have government FHA HECM reverse mortgages, and you have non-government reverse mortgages. It's important to note the difference between the two, and I have a video dedicated just to that. There are also reverse mortgage qualifying factors when applying for reverse mortgage as well. Some of these additional qualifiers are the property must qualify having enough equity and not having any health and safety issues in the property as well. But I'll make another video for the property qualifying at a later time. This video is strictly for income qualifying. So thanks for watching. I do lend in California only as of this moment. This information provided is as of July of 2022. And feel free to contact me by clicking on the Tell Me Your Scenario button on my website, or email me, text, or call me with any questions you may have on how reverse mortgages work, and I can make a video for your unique situation. So have a great rest of your day, and thanks again for your time. Bye.